Hello everyone, welcome back to week 4 lecture videos. Just a reminder that we are discussing this week the capital budgeting methods. So we already discussed discounted cash flow techniques and non-discounted cash flow techniques with a special emphasis on NPV. So in chapter 6, we will be discussing different rules of applying NPV in different capital investment projects. So basically, we will discuss the rules associated with estimating cash flows for a capital budgeting process, the rules of treating inflation, taxes, and we will also see how we can take decision in the case of the timing difference of a project and also in the case of the projects that have different lives. So as far as NPV is concerned, we need to be very careful about 3 rules. First one is only cash flow is relevant. Second one is we need to estimate the cash flows on an incremental basis. And third one is we have to be very consistent while treating inflation. So first of all is rule 1, estimate cash flows, and cash flow is only relevant for calculating NPV. The first and the most important point of NPV is that it depends on future cash flows. Cash flow is the simplest possible concept. It is just the difference between cash received and cash paid out. Many people nevertheless confuse cash flow with accounting income, but in one of the videos in this week, we already discussed the difference between cash flows and accounting income. So as far as the cash flow is concerned, it is primarily different from the income, as some income includes some cash flows whereas exclude others. And also income is reduced by depreciation charges whereas cash flow is not. Okay, but we need to understand that it's not always easy to translate accounting data into actual dollar amounts. And also, as far as cash flow is concerned, we need to estimate it on an after-tax basis. You should also need to make sure that cash flows are recorded only when they occur and not when the work is undertaken or liability is incurred, as it is done in the case of income. If I want to give you an example, taxes should be discounted from their actual payment date, not from the time when the tax liability is recorded in the firm's books. Also, if working capital is required for taking a project, we also need to consider the changes in the working capital that is associated with accepting the project. The second rule is estimate cash flows on an incremental basis. Okay. So the value of a project depends on all the additional cash flows that follow from project acceptance. Okay, that means if we take a project and it have an impact on the firm's cash flows, that means it causes a changes in the firm's cash flow, we are concerned about only the changes in the cash flows. So we have some rules here to estimate these incremental cash flows. First of all is to remember include taxes, as I already mentioned, that when we consider estimated cash flows, we need to include taxes, so we only consider the after-tax cash flows. Do not confuse average with incremental payoffs, okay? So most managers naturally hesitate to throw good money after bad. For example, they're reluctant to invest more money in a losing division. But occasionally you will encounter turnaround opportunities in which the incremental NPV from investing in a loser may be strongly positive. Conversely, it does not always make sense to throw good money after good. A division with an outstanding past profitability record may have run out of good investment opportunities. You would not pay a large sum for a 20-year-old house, sentiment aside, regardless of how many regardless of how many or how much cash flows it has generated in the past. Okay, so when we consider about investing in a project, we should not base our decision on the average profits or average cash flows or average rates of return that this similar sort of investment has generated in the past. Rather, we need to consider how much incremental payoffs it's going to generate in future. We need to include all incidental effects. So incidental effects means a project may have an impact on the remainder of the firm's business. Sometimes it's possible that a project has a positive impact on the other divisions of the firm or other parts of the business. Then it should be considered as a cash inflow, this positive impact. On the other hand, if a project may have a negative impact on the other parts of the business, that should be considered as a negative cash flow or a negative impact of the project on the rest of the business. For example, let's say that Newcastle University, its main campus is in Newcastle City, planning to open a new branch or planning to open a new campus in Sydney. Now, Sydney students typically travel to Newcastle to get enrolled in Newcastle University. So if a new campus is opened in Sydney, the Sydney students are unlikely to come to Newcastle to be enrolled in this university. Rather, they will be enrolled in the Sydney branch, I mean Sydney campus. As a result, the number of enrollment in Newcastle is supposed to decline. So you can see that considering as a standalone campus, Sydney may be profitable. However, it may have a negative impact on the Newcastle University's existing operation in Newcastle. On the other hand, a project, as I said, may have a positive impact. Let's say an airline company that's considering to open a new route between Newcastle and Canberra. Now, once again, as a standalone route, it might not be a very profitable one. It might not seem to be a very profitable one. However, its impact on the other business or impact on the other routes might make it's a very good project. So, as far as a new project is concerned, we need to consider that whether a project has a positive impact or a negative impact on the remainder of the business. We also need to include opportunity cost. Opportunity cost is the rate of return or the benefit foregone for the second best alternative use of the resources. For example, you take a project and that project is planning to construct a factory building on a land that was remain unused. Well, although the land was remain unused that is used to construct a factory building, these resources is not free of cost. It's an opportunity cost because the land could otherwise be sold at a certain amount of money. So the opportunity cost of this land is the amount at which the land could be sold. This opportunity cost must be considered in evaluating a project. Forget sunk cost. As long as a cost is a sunk cost, we should not consider it in evaluating a project. Sunk cost is the cost that has already been incurred and it doesn't have any impact on the accept reject decision of the project. So we should ignore the sunk cost. Then we need to be aware about the allocated overhead cost. Overheads include items such as supervisory salaries, rent, heat, light. These overheads may not be related to any particular project, but they have to be paid for tomorrow. Therefore, when the accountant assigns cost to the firm's project, a charge for the overhead is usually made. Now, our principle of incremental cash flow says that in investment appraisal, we should include only the extra expenses that would result from the project. Okay? So, although a part of the overhead of the business may need to be paid by the new project, however, if the new project does not add up any new overhead, then this overhead should not be included in the project's evaluation. We also need to remember salvage value. Salvage value is the value of the project at the end of the economic life of the project, or the value of the or the value at which a project can be sold at the end of the life of a project. So salvage value needs to be considered as a cash inflow because at this price we will be selling the assets associated with the project. Sometimes there may be a substantial cost associated with the shutdown of a project that should be considered as a cash outflow of a project. So this is the second rule, estimate the cash flows on an incremental basis. The third rule is treat inflation consistently. Well, incorporating inflation in a project evaluation is pretty easy. Okay, the main rule is we have to be consistent. We have two factors. One is cash flow, another is discount rate. Okay. Now, if we consider nominal cash flow, we should discount this nominal cash flow with a nominal discount rate. On the other hand, if we use real cash flow that is adjusted for inflation, then we should discount it with a real discount rate, which is also adjusted for inflation rate. Okay, so that's the meaning of consistency. If we use nominal cash flow, we should not discount it at a real discount rate, or if we use real discount rate, we should not discount it with a nominal discount rate. Here we have an example. So real discount rate is calculated as 1 plus nominal discount rate divided by 1 plus nominal inflation rate minus 1. Okay, so the example is you invest in a project that will produce real cash flows. I repeat, real cash flows of $100 in year 0, then $35, $50, and $30 in the 3 respective years. If the nominal discount rate is 15% and the inflation rate is 10%, what is the NPV of the project? So I repeat you the rule. Nominal cash flow, nominal discount rate. Real cash flow, real discount rate. That's the rule. Now, these $35, $50, and $30, if you can remember, those are the real cash flows. Okay. So this $35, $50, and $30, since these are the real cash flows, one approach of dealing with this is convert them into nominal cash flows. So 10% was the discount, 10% was the inflation rate, so we multiply it by 1.1, 50 is 1.1 square, and 30 is 1.1 cube, and these are the nominal cash flows. Since these are the nominal cash flows, now we can use nominal discount rate, which is 15% to discount the cash flows, and you can see that the NPV of the project is $5.5. The other way to handle this problem is calculating the real discount rate. You know that nominal discount rate is 15% and inflation rate is 10%. Using the formula, we get the real discount rate is 4.5%. So we have these real cash flows, we simply discount them by the real discount rate 4.50, and we see that the NPV of the project is $5.5. So either way you have the same NPV. Okay, so if we use nominal cash flow and discount it by nominal discount rate, and if we use real cash flow and discount it by the real discount rate, that should produce the same NPV. So that's all of our discussion on the NPV rule. Thank you.